this case, it's a complex pattern because it consists of more than one candle. It's a bullish pattern because it indicates a move towards the upside, and it's a reversal because it reverses the price from a downtrend to an uptrend. So now then, how do we identify a bullish engulfing pattern? Well, step one here is that we need to see a downtrend. And after the downtrend, these two candles appear. I hope you can see here that the candles before the pattern has a slightly different color, and also the candle here after the pattern has a slightly different color. And I will do this for all patterns. But the actual patterns are these two candles right here. The first candle in this pattern is a red one, and preferably we want the real body of the red one to be relatively small. It doesn't have to be super small, but it's often a good sign when we have a small real body. As for the wicks here, it doesn't matter too much. These wicks can be longer or shorter. It will not have a big impact on the pattern. The next candle of the pattern here is more important. It's this green candle right here. And in order to find a bullish engulfing, we want the next candle to be a green one, and it needs to open below the close of the red one. So it needs to open below this point right here, and the green candle needs to close above the open of the red candle. And this is why it's called an engulfing pattern, because the green candle is larger and engulfs the previous red candle. If you're trading, for example, crypto, where the closing and the open prices are at the same level, it's enough to see a pattern that looks something like this. Let's say that this is the first red candle right here, and this right here is the second candle. In crypto and some other markets, the next candle will open at the same place as where the previous candle closed. So in these scenarios, what you are looking out for to confirm a bullish engulfing is simply to see a candlestick that closes above the previous red one. When the green candle closes, then the pattern is confirmed. And as I said, the pattern indicates a reversal to the upside. Now let's take a look at the bullish engulfing pattern and how to trade it in a real market. Alright, so right here we have a chart, and remember, it doesn't really matter what time frame this chart is. I think in this case it's a daily chart, but you can use candlestick patterns on any time frame. And if you want to, you can try to find the bullish engulfing pattern on your own. So feel free to pause the video right now. Did you find the pattern? Well, the bullish engulfing pattern, at least the most obvious pattern, is this one right here. You can see that before the pattern appeared, we had a strong movement to the downside. We actually saw a little bounce, but then we saw yet another push towards the downside. The first candle is a small red one, and the next candle, the green candle, opens below, right, and closes above the previous red candle. The most common entry point is to enter when the candle closes, so at the candle close of this green candle. But where do we set our stop loss? Well, the most common level here is to set the stop loss just below the lowest point of the pattern. So in this case, the lowest point comes from this wick right here, but if the red candle has a lower wick, we usually set the stop loss below that wick. Another important point to consider when you place your stop loss is previous market structure. And what do I mean by this? Well, in this case, you can actually see that we had a low right here as well. And you can pretty much see that we have a sort of double bottom looking structure here. And when we have another low at the around same level, what I like to do is to actually place the stop loss below the sort of support created by that level. So in this case, you can see that these two lows are pretty much at the same level. But if one low is slightly lower, I like to place the stop loss below. So in this case, I would set the stop loss around here. As you also can see, I usually leave some wiggle room right here. So if the price, comes down to the support once again, we have some room for the price to bounce here before we get stopped out. But what about your target level? Well, here you can keep it simple and use a risk to reward ratio. A risk to reward ratio tells us how much do we gain compared to how much we lose when we take the trade. So for example, a risk to reward ratio of 1 to 2 means that we risk $1 for every $2 in profit. Or in other words, the distance here from the stop loss to our entry point should be half the length of the distance up to the profit target. So in this case, our profit target would be around here. This video was just a short clip from our full candlestick pattern trading course. So if you have the time, I highly recommend to click or tap on the screen right here to watch the full video.